think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. And today we are joined again by my friend Steve from the Unemployed Value Degen. How's it going?
Oh, it's going really well. Thank you for inviting me, Daryl. And early Merry Christmas.
Yes, same to you, same to you. Yeah, so for Christmas, some people were able to get some stocks at a discount. It's almost like a Black Friday sale, but Christmas sale. Santa Claus rally did get rocked by the Fed, and yeah. So and then you also got many other issues like tax loss harvesting and such. And so some of these stocks are getting pummeled right now. And so what's your view there? Are you buying, or what are you thinking?
Yeah, yeah. So I'm well. It's hard because I'm always fully invested, and I have stocks that I'm willing to let go of to rotate into things that are cheaper right now. But if I just wait till January, then when I pay taxes on it, instead of paying those taxes in April of 2025, I can pay them in April of 2026 and get to keep reinvesting those gains for a whole nother year. So I've been making little changes around the margins, but for the things that I want to really let go of, I've been looking more at January. But we've been through this. We just had 14 trading days in a row down on the value factor. So if you look at an ETF that focuses on value, it's 14 straight red days in a row. That's only happened one other time, and it was in 1978. So you don't have a lot of data on what happened. I mean, this is really extreme movements. And during most of that time, the Magnificent Seven were just grinding higher. It's like people want to sell everything and just go levered long on the Magnificent Seven. And maybe it's eight now because Broadcom is over $1 trillion. Maybe now it's the Magnificent Eight. But it's just crazy moves that you don't see but once every 50 years. But I think that means things are on sale. Things are cheap right now.
Mm-hmm. Yeah. I mean, there's like a lot of talk around the great rotation, which we talked about that before, and I think that everything comes down to timelines. Right now, obviously, the AI craze, and then you got quantum computing and everything, and these stocks have just been running significantly, and so
Yeah.
but yeah, like these other companies, they're solid companies. Like we have some solid companies out here that are getting no love, and so we're able to get in early at least.
Yeah. I mean, there's some things that are just good companies and taken right out to the woodshed and just sold off without mercy. But it's I think they're good buying opportunities if you're not already fully invested, or if you get that little extra bit of money from whatever paycheck and you want to deploy it. There's so many things I want to buy right now. I've got more ideas than money.
Yep. That makes. I agree with you. Yes. So I want to dive into some of the companies you all. Today we're going to do something where I'm going to gift a subscription, 3 subscriptions to Steve's newsletter. It is only $5 a month, but I'm going to gift 3 of them. So if you click the link in the description below, enter your email address, I will enter you into a drawing so that you can receive a free newsletter. And otherwise, support the man anyway. I mean, it's very cheap, and there's a lot of companies that you could be positioned in, especially and not chasing these huge green candles from some of these quantum computing stocks and such. And so I want to start with the recent company that you wrote about. This is a company that is a trifold, has a kind of like a trifold model with dry bulk, containers, and tankers. And it's called Navios Maritime. Navios Maritime Partners. And so I wanted to talk about this company because I was reading your recent article, and you mentioned a few points that I was like, okay, I got to pick Steve's brain on this. So I like how you write the articles because you give the bear case as well as the bull case, and obviously, you know, investors should be considering, well, depending on your investment style, should be considering some type of asymmetry. And so, when we're looking at this company, you had mentioned that Greek ship owners and managers have a reputation for choosing themselves over shareholders, right? And so,
Yeah.
when we look at the tanker market, I've heard things about that have happened with Greece, with different types of companies and such, and with investments and everything. Like, what are the risks with Greek companies like this, companies like
This
this?
is I mean, it might just be a stereotype. Maybe it's not all Greeks, but with any stock, I always try and look at management incentive alignment, because there's a lot of companies out there where the C-suite executives, they're running the company for themselves. A famous case is Samsung. Whenever Samsung has extra money, they spend it taking all their top executives on training trips down to the beach. They don't take that extra money and give it back to shareholders. So this is not a uniquely Greek problem. But when I was writing about it, it's this old quote, beware of Greeks bearing gifts, because of, the Iliad and the Trojan horse and all that. But the Greek shippers have a bit of a reputation of being scoundrels, of choosing management over shareholders. Um, and I think for that reason, I've been focusing on a lot of other shipping names from the Scandinavian countries, especially where if you have a large shareholder that owns maybe 10% of the company and he's actively buying more stock over time, then there's a pretty good indication that that company is going to be run for the shareholder. In this case, with the Greek shipping company, Navios Maritime Partners, um, the founder is just especially hated. And a part of that, might be her fault. Part of it might just be the timing. One thing about shipping is it's a very cyclical business. This is a kind of stock that you want to date but not marry. You don't buy and hold shipping stocks forever. Um, in the last down cycle, the founder of Navios Maritime Partners, she had several different companies. The tankers were their own company, the dry bulk were their own company, and the container ships are their own company. And it was like a slow rolling bankruptcy process. And so she merged all the companies into one. And through that process, a lot of shareholders got, really strongly diluted. And she did too. I think she got her ownership diluted all the way down to 5%, but she had enough cash on the sidelines that she bought back in up to 16%. So um, there's so few shipping investors anyway, that when they get burned by a name or they get burned by an executive, they kind of swear off the thing. And that's, I think, one of the reasons why this stock is so cheap, is because the only people who are interested in shipping, they already lost money there once. And they say, oh, no, fool me once, okay, but don't fool me twice. So this founder is especially hated. The name is especially hated. But going forward, and then maybe she abused shareholders, or maybe it was just this, maybe it was that, or the companies went bankrupt, because it was a really tough time between 2012 and 2020. But going forward, um, a lot of countries all over the world, their shipyards for building new ships, they're offline and dismantled. We've got something close to half of the global shipyard capacity we once did. And part of that is because wealthy countries like South Korea said, we don't really want these cyclical jobs. We don't want to have to deal with every few years all these people get laid off and we have to pay unemployment insurance for them. So some countries strategically chose, just we don't want that business. And China's, embracing it, but there was a period of time in that shipping bear market where some shipyards went out of business and they didn't get bailed out. They just failed. So if there's gonna be a restriction on how many new ships come online, how many new ships are built, then the people that own the old ships should have a huge advantage, because that supply squeeze means the day rate should go up. That's the overall thesis for being in any kind of shipping right now, is that the shipyard capacity is down. So it's going to be really hard for new ships to come online. So it's a good time to own ships. And then on top of that, go ahead.
Yeah. So it's a good time to own ships. I mean, many of these tankers have been plummeting. I mean, I was looking I was looking at a cool coal the other day, and then I saw you recently had written about them and everything. So with this company, you mentioned that in the article that uh, this is a way that you can get huge exposure to China without investing in the Chinese markets. And I was kind of wondering how, I mean, obviously, some things we can't really account for or factor in, but some people think of like the tariffs or trade war. Like how does this impact any type of business with China from other nations or whatnot? Does this business? I mean, obviously, it's not an American company, so that's a factor there. But how do you factor that into when we consider a company like this?
So a trade war, because we did have, Russian sanctions and Russia being cut off. And I think a lot of people are worried about, well, what would that happen? What would happen if we did that to China? And if you look at the size of the Russian economy and how integrated it is with the rest of the world, like the UK, who's much closer to Russia than we are, their biggest grocery store, I think it was Sainsbury's, went through and they wanted to remove all Russian SKUs from the shelves. And the grocery store has 40 to 80,000 SKUs in it. They only found two products in the entire grocery store that came from Russia: sunflower seed oil and sunflower seeds. That's it. In the Russian economy, aside from oil and gas, it is tiny and it's not interconnected. So putting sanctions on Russia was pretty painless for the US. Having some kind of a trade war or a total blockade with China, it would be because we're so interdependent. And this is what the classical economists used to say leading up to World War I with all these trade restrictions, that if goods can't cross borders, armies will. But the economies of the US and China are so interdependent. I mean, the amount of trade between them is enormous. You have President Xi coming to or invited to Trump's inauguration. And Trump has this strong desire to go down in history as being the great deal maker. So I think it's going to be interesting to see what kind of tariffs actually get implemented. But whatever tariffs get implemented, I think the Western or the advanced economies are fighting over the high value added stuff. They're not really fighting over the low value added stuff. And dry bulk shipping, we're talking about ships that are full of coal, ships that are full of iron ore, ships that are full of grain, and ships that are full of bauxite, the aluminum ore. This is stuff that is this is stuff that's going to move around the world from the countries that mine it to the countries that use it. And I think more important than the sanctions, or the tariffs, which I mean, something could happen. So I wouldn't make this stock like 20% of my portfolio. Something could always happen. I think it's much more likely that China's economy has been struggling the last few years as they're digesting this huge overbuilding of apartments. And China recently announced that they're going to bring out the stimulus bazooka and they are going to support their economy. And on top of that, you have, the United States, people have been saying that we have this strong GDP growth, but it's all been government employees and healthcare employees, and they don't use any natural resources. So if you have Trump coming in saying he's going to waive all permits for companies that invest over $1 billion, and you have China with the stimulus bazooka, I think there's a chance that the commodity-based economy of moving physical stuff might accelerate. So I think that's probably more likely than having some huge tariff war that affects all the way down to where you have to have some pretty extreme tariffs before China stops importing iron ore or coal or something like that, because it's just such cheap stuff and it's so vital. And that's what the dry bulk shipping world is like.
Okay, yeah, that's good. That's good to hear. I mean, especially you get all of these fear mongering from news sites and everything. And I mean, some people haven't touched China with a 10-foot pole, but I was positioned when they announced the stimulus, and I've benefited from that significantly, investing in some of their companies. But obviously the companies are ADRs, and then like there's still like this risk there with Chinese companies, and so this company specifically, in particular, gets exposure there without investing directly. And so that's what's kind of something that intrigued me or piqued my interest. Um, so you mentioned that this company could potentially be paying up to $24 of dividends a year. And you went through the financials and such, and I'm looking at the financials now, and it looks like they've grown their cash over year, as well as their values of their vessels. They've reduced their debt, and you, from what I was reading, you were projecting that they're going to keep reducing their debt, and this will increase their revenue over time.
Yeah. So the founder, chairwoman, and CEO, she has these. So it's structured as a partnership, which some people have to worry about. But for tax purposes, it chooses to be taxed as a corporation because you have some problems sometimes in a retirement account. You can't accept master limited partnership dispersions, or you get taxed on it again. But it's called Navios Maritime Partners, but it's taxed as a corporation. But with that partnership structure, you have the general partner or the limited partner. So aside from being a 16% shareholder, the founder and chairwoman, she has these incentive rights. And these incentive rights are any year that the company dispenses to its unit holders more than $24, she starts getting huge performance-based compensation. And I mean massive. Now, this last year, it had over $12 in earnings per share. To get from $12 of earnings per share to actually having $24 or more than $24 and paying it out in dividends, I think it's going to go in 3 steps. The first step is happening right now, which is debt pay down. The second step is going to be aggressive share buybacks, because if she's so hated and the stock price is so cheap, then just go ahead and do the share buybacks and buy back your own stock. And if she shrinks the float by half, which at current prices it could easily do in 3 to 5 years, well, then just has to flip a lever, and that $12 of earnings per share is $24 of earnings per share, and just pay it all out in dividends. And then instead of just being the 16% owner, now she's receiving this massive, enormous performance compensation. So there's a situation where just accidentally, because of the structure of things, it looks like what's in her interests would also be in shareholders' interest, because who wouldn't mind having a company for the next 3 to 5 years bought back half of its float? And that would be and then also if you're holding it, then after that you start receiving huge fat dividends. So it's just speculation that that's her plan, but that's the incentive alignment that she has as the general partner managing this partnership, that she has access to those. And any reasonable person would be on that journey. I mean, she knows what those incentives are. And so I think it's step 1, pay down debt. Step 2, share buybacks. Step 3, change it all over to 100% dividends. I think that's going to be a process over the next 3 to 5 years.
So what would you be paying attention to at this point of this process? Obviously the projections and speculation of like what's potentially going to happen. Like, what would you be paying attention to where you would lean you more towards like, okay, yep, there's no question about it, I need to own this company?
So that's a tough one. I think the thing that I'm watching for right now for shipping is we have the Houthis in the Red Sea, and they were, firing missiles at ships and blowing them out of the water. And so a lot of ships that could have fit through the Suez Canal have been going around the Cape of Good Hope of Africa. So that increases the length of the voyage, which drives up the day rates of all these ships. Now, this has made a lot of ships earn a lot of money over the last couple of years. So a lot of shipping companies have huge abnormal profits because they could have gone from Europe to China through the Suez Canal. Now they got to go around Africa, and it's a much longer journey. And the way Trump wants to go down in history as this big deal maker, people are saying, okay, is he going to come in? He says he's going to end the Ukraine war on day one. Probably he's going to do some sort of peace with the Houthis. The shipping stocks prices all started crashing in mid-October, exactly when the betting market said Trump was going to win. So it's really a tight correlation between when the market thinks Trump is going to win, all these shipping stocks crash. So I'm going to be interested to see what day rates do after the Red Sea is open again for these shipping stocks, because I think it might be um, people might be taking it too far. There's a lot of ships that don't even fit through the Suez Canal, and there's a lot of ships that had to go around Africa anyway. So the effects of this, especially if you're looking at the oil tankers and the dry bulk, some of these ships are so big they don't fit through the Panama Canal, they don't fit through the Suez Canal. They have to go the long way anyway. So and also the supply, right? Um, ships get old. Any ship over 20 years old, you're serious customers. So if you're doing say, take a cargo container ship and you're carrying cargo for, a serious multinational corporation, they don't want their cargo on ships more than 20 years old because the insurance companies are not, providing insurance so readily, and the ships become dangerous. So there's this huge threshold when ships become over 20 years old that, the jobs available to them are limited and they have to start looking at the scrap yards. So as time goes by and more ships have to be scrapped, the fundamental thesis is that the global shipyard capacity fell in the last, several years, last decade. Global shipyard capacity has fell. There's just not that many new ships coming online in some of these sectors. Another thing is, not only did shipyard capacity fall, but we had this natural gas revolution. So the shipyard capacity that was there, they were building two things. They were building natural gas carriers and they were building the cargo container ships. So when there was the COVID supply chain, I remember reading these news articles that there were 100 ships off the port of Long Beach in California that couldn't unload. When that was going on, right, as those ships were stuck there anchored off the port of Long Beach, the day rates for container ships just went up and up and up. Well, the companies, as we were talking about the incentive alignment, did the cargo ships take that money and pay it to shareholders? No, they ordered new ships and to be built in the shipyards. So there's fewer shipyards, and all the shipyards are booked out years in advance to build the cargo container ships and the LNG carriers. So in oil tankers and dry bulk, I have another write-up on a company that does car carrying ships. And well, Coolco is a natural gas company, carrying company, but then you have to see how many years the contracts are for their fixed day rates. But anyway, and drill ships, if you like all the offshore drilling with Valaris and Transocean and Noble. So those sorts of things, the shipyards are empty, right? The order book is empty. The shipyards are full of LNG carriers and cargo container ships, and nobody's building that much for dry bulk, for tankers, for all the other stuff. So, and then as the ships get older, some of them get scrapped and you get the supply and demand problem. If you look at the day rates, and I don't know if you can do a share screen or something like that, but the Baltic Dry Index, let me just pull this thing up. And I don't know if you have,
give you permission real quick.
Yeah. So if I take the Baltic Dry Index, okay, are you seeing this thing?
Yep,
So the Baltic Dry Index, this is just one way of measuring this dry bulk carrying stuff. Well, I mean, these prices hover between 1,000 and 2,000 going back for 35 years. But look at this period from, say, 2003 to 2008. You got this 5-year period where prices were 4 to 10 times the normal prices. That's huge. So you have this several year period where these things are earning many, many multiples of what they would normally earn for day rates. And that can happen in any sector. That could happen to tankers. It could happen to cargo containers. It could happen to dry bulk. It's just that in that specific sector, how many ships are there? And then, how long is it going to take for those new ships to come out of the shipyards? And because the shipyards are full, if you place a new order and those ships take a couple years to build, we're talking about new ships being delivered in 2028, 2029. That's why you can have 3, 4, 5 years of these prices just being absurdly high. So, and this is just another reason why shipping is heavily cyclical. You don't really want to own all this floating steel when the prices are all, at this $1,000 a day, $2,000 a day thing. But if you can be invested in it, like you fill your bingo card for have exposure to several sectors and see if one of those sectors gets lucky. I think dry bulk has a decent chance of being one of the sectors that gets lucky. Tankers could be one of those sectors that get lucky. It might be harder for the boxed containerized cargo to be lucky, but it could happen again. I mean, I'm not an expert on every sector, but it's really about if you happen to be in that sector when it gets lucky, then you want to have bought it beforehand because the price will have appreciated so much you can't afford to buy it after that's already happened. And there's just no way of knowing in advance which sector it's going to be like that.
Yeah, yeah. Yeah, that's good. That's good. You all be sure to click the link in the description below so that you can be entered for a free subscription to Steve's newsletter. It's only $5 a month. I'm going to link to that in the description below as well. So be sure to click that. I mean, you all are seeing the value that he provides with what he just shared and everything. And so appreciate you for sharing that. So I do want to jump into another company that you've talked about on your newsletter. This company is called Doug. So what is this company about, and what are the things that intrigue you to really start researching this company?
So this is one of my paywalled stocks, and what I was looking for is so we're in this environment where the existing housing market is totally frozen. And you always want to skate to where the hockey puck is going. I mean, the existing housing market can't stay frozen forever. At some point, there's going to be a real estate broker that bounces back. But on top of that, so other things have been happening with the real estate. So there was this huge antitrust lawsuit against the National Realtors Association. And because in the US, you had the buyer's side, you had the buyer's agent and the seller's agent together. You had transaction commissions for transactions on a house were 6%. Most of the rest of the world, that's under 2%. In the United States, we had huge broker transaction fees. And there was an antitrust lawsuit that won. And now nobody knows exactly how real estate brokers are going to get paid going forward in the future. So this is an area, the whole real estate broker stock market. I mean, these stocks are in the toilet. Because there's a lot of danger and uncertainty there. Now, Douglas Elliman is a real estate broker, but they're at the extreme high end. So some real estate brokers, their average transaction is $400,000 a home. Because you got some in Alabama that are $200,000, you got some in Massachusetts that are $600,000, but on average it's $400,000. The average transaction for Douglas Elliman is 1.4 million. That's at the average. Right, so Douglas Elliman they were the buyer's agent for Jeff Bezos when he wanted to buy his thing in Miami. So this is the extreme high end. What's interesting about the extreme high end of real estate brokers is the buyers are all cash buyers, so it's not interest rate sensitive. So while we're waiting for interest rates to come down so that Remax and the other real estate brokers can get some volume, the high end real estate, it can have decent volume, even a high interest rate. So if interest rates are going to stay high, this is going to be a real estate broker that can bounce back faster. Now, it still is interest rate sensitive because even though they say they're an all cash buyer, a lot of times it's a stock-based loan. So they take out a cash loan against their stock portfolio, but they tell the broker it's an all cash offer, but they've got a loan from somewhere else. But it's going to be much more correlated to the stock market being at all-time highs than it is to the interest rate, because people, maybe they founded a company, maybe they want to cash out $10 million of stock and they want to buy something somewhere. So that's the overall thesis of this company, Douglas Elliman. But there's two things about it. So the reason why I put this behind a paywall is because sometimes when I dig through the accounting statements, I find stuff that gets lost so more than 60% of the volume in the stock market now is quantitative. It's algorithms. Some things the algorithms don't pick up on. When I looked at Douglas Elliman's assets and liabilities, there was this strange item for it's a deferred liability deferred revenue. Deferred revenue shows up in the liability side of the balance sheet. If you look at Starbucks, when Starbucks sells a gift card, they get the cash immediately. Like you go to Starbucks, you give them $50 for a $50 gift card. Starbucks has received the cash. But now they're on the hook. They have to deliver you coffees. So even though they receive the cash now, it shows up as this thing called deferred revenue, and it's a liability. The former CEO of Douglas Elliman, who's just, there was kind of a coup. There's a huge drama surrounding it, but there was kind of a coup. And the CEO, who'd been the CEO for 20 years, retired or was asked to retire. His strategy for getting through COVID was not to focus on existing home sales, but to focus on new build condos, particularly in southern Florida. So these new build condos, when the real estate agent sells a new build condo, they get paid half their commission right now. But because of the accounting rules, it was treated the same way as when Starbucks sells a gift card. So Douglas Elliman has this huge liability on their balance sheet called deferred revenue. And it's as if they owe all these cups of coffee to customers, except that Douglas Elliman's the broker. They're not the ones building the condo, right? They don't have any costs associated with that revenue. It looks like they have these huge liabilities, and it looks like they haven't been profitable for 4 years, but they keep on receiving this revenue, and it goes to the liability side of the column. These condos take about 4 years to build, and the very first new build condos since the old CEO started this program, they're going to start hitting right now. We're approaching the very first quarters where some of these deferred revenue pieces actually leave the liability side. And so this company has been profitable for 4 years, but it appears unprofitable. And once this starts rolling off, it's going to be profitable and appear profitable. So that's going to be a huge tailwind for them. And then, so that's why I put it behind the paywall, because there was a tricky bit of accounting with this. And there's another part of these new build condos, which is the broker receives half the commission when the contract is signed, and the other half of the commission when the unit's delivered. So not only do they have this item that's called deferred revenue, it's a liability. Not only is that going to roll off the liability side, but when it does roll off, they're going to receive just as much money for the second half of their commission payment for selling these new build condos. And then it gets even better because mortgage rates are now 7%. So suppose you had 4 years ago given $300,000 to a broker to put your name down for one of these new build condos, under the understanding that when it is delivered 4 years later, you're going to take out $1 million mortgage and move into it. Okay. Well, you thought that $1 million mortgage would be at 4%. Now it's at 7%. So now that the condo is ready to be delivered, your Douglas Elliman broker calls you up and says, hey, this condo you put a $300,000 down payment on, it's ready to be delivered. Are you ready to pull the trigger on $1 million mortgage? Or since prices have appreciated these last 5 years, would you like me to go ahead and put it on the market and try and sell it for 2.1 million? And you can take, a nice $400,000, $500,000, $600,000 gain on it. When that happens, so they're not only going to receive the second half of the initial sale from the new build condo, but a huge chunk of these buyers are going to become, unintentional resellers. And then they'll make another commission when they resell the thing. So this has created a huge pipeline where they not only have this weird accounting feature where they've got all these pent up profits that they're going to receive, but they're also going to have this huge volume of business from people that realize that they don't want to do a 7% $1 million mortgage just to live in Boca Raton. So this is the mechanics of this and the way it's going to work and the way it's going to play out over the next few quarters, I think is pretty tempting. And the price just crashed back down with this 14-day sell-off in value, and also with rising interest rates. But again, I think their business is much less interest rate sensitive than all the other real estate brokers.
Yeah, I'm just sharing a chart of the current price. They're sitting at $1 and about 65 cents. They IPO'd in December of 2021. Is that correct?
Yeah. It's a terrible time to be a broker with interest rates rising and then the COVID. So you had this huge volume of transactions during COVID when everybody left the city and moved out to the country. But then with rising interest rates, the stock price just crashed and crashed and crashed and crashed and crashed.
Yeah, because the Fed announced rising interest rates earlier in 2021. I think it was maybe in the fall or something, but yeah, then they just started hiking. You had the fastest rate hike cycle in I think in the history, and so yeah, this is sold off significantly. And even if it were to even go back to like its IPO price or something, like you can easily get what 7-8 bagger or something like that.
Yeah, I think it could be a $10 stock, but they did do some convertible debt. And this is one of those weird things because this is a company that had very little debt. They had some most of their liabilities was deferred revenue, but they had very little debt and they had plenty of cash on the balance sheet. The past CEO issued some convertible debt and the market hated it. Like, what the heck is this guy doing? You have cash, you don't have debt. Why are you putting out a convertible? And the reason is it was to a strategic entity. So you see sometimes companies will sell a piece of themselves strategically. And what it was to one of the major financiers of these luxury new build developments. And I think what they did is they sold, even though stock price was really low, so it was a bad time to sell a piece of themselves. And even though they didn't need the money, they sold a piece of themselves anyway to this entity because if they're going to be financing all these luxury new build developments, they can go tell the builder, hey, this is my preferred broker. I want them to sell all the units. So I think the past CEO was locking up all this future volume, and the market really hated that they did a dilutive convertible raise when they didn't need the money and the stock price was really low. But sometimes you'll sell, like if you ever watch Shark Tank, you'll find sometimes people go on there and there was one at the university I used to teach at. They made a product called Nightcap. It was a hair scrunchie that can cover your drink so that people can't stick a roofie in there while you're drinking it. And they didn't really need the money. What they needed was they needed a partnership with Lori Greiner so she could put it on the home shopping channel because she knows what she's doing. Sometimes you'll sell a piece of your company just to have that strategic tie-up. And so they sold a part of Douglas Elliman to this financer of luxury new builds because they wanted that strategic tie-up so that they get all this volume that they can be the broker for. And the market didn't understand it and the market hated it. So there is some dilution. But yeah, I think the stock is going back to $5, $6 pretty easy.
Hmm. Yeah, yeah. You all got one of Steve's picks. You all behind the paywall. Be sure to go subscribe. Again, I'm gonna keep saying it all interview. Be sure to go subscribe. I know we had discussed talking about at least one more company, but I mean in the interest of time, I think if we can talk about another company, which one you think we should go? Should we go? Let's see, we had JAKK or NWL.
Yeah, well, I really like JAKK's, especially because it's Christmas and they're a toy manufacturer. So we can talk about Newell brands next time. But JAKK specific, the symbol is JAKK. They are a toy manufacturer, and they had been through really rough times. And whenever a company's failed so hard, you got to try and figure out why they're failing. And I think this company was failing. It had a entrepreneur founder who founded the company, and the company did fantastic for 10 years. He passed away, and one of his good friends who kind of sort of he didn't found the company with him in a way that he had skin in the game, kind of founded the company with him in the way that he was a friend and an employee. I'm pretty sure this guy drove the company into the ground for the next 10 years. And that's the reason why it had done so poorly. And then they hired a new chief financial officer, but he's also an executive vice president. And I think what's happening is the CEO who's still there, who was kind of sort of a co-founder of the company, I think he's been put out to the golf course, and I don't think he touches anything anymore. I think it's the new CFO who's an executive VP who has this like amazing background at got his finance degree at MIT. He worked for Disney and Mattel as head of mergers and acquisitions. Is a pretty extremely qualified and seems to be a very capable guy. I think he's in charge of things now. And ever since he came in, this company went from complete and total, riding on the struggle bus. I mean, even the short bus, right? This kid is going to school on the short bus. This company, they were over indebted. They had this awful preferred stock, which limited any return. They were completely prohibited from returning any capital to shareholders. They were really on bankruptcy's door. And then as soon as they hire this new CFO, they turn everything around. They're profitable. They pay down all their debt. They were going to be on a runway to pay down the preferred stock over the next year or so. And then the holders of the preferred stock asked them and asked to get bought out quickly. So now they have very little cash, but they retired all their preferred stock. And then if you look at the performance, so this business, they're a toy manufacturer, but just as a toy manufacturer, it's not an amazing business. So I like to compare it like restaurants are not the most profitable, not the most amazing business, but you find some people that make a lot of money at it is they have the restaurant just to pay the bills, and then the real money comes in from the catering, right? Once you have the base restaurant to cover all of your fixed costs, every catering job you get, it's like pure profit. JAKK Specific is kind of like that. So they have their everyday toys as a toy manufacturer. But when there's a children's movie that has merchandise associated with it, they bid on the licensing rights for the toys for that movie. And that revenue, once they have all their fixed costs covered with their basic toys, the revenue from these movie merchandise, it's huge margin. And when you look at their earnings recently, Disney's Wish was really a box office bomb. Disney's Wish did not lead to a lot of merchandise sales. But November, we just had Moana 2 released. And then last week or 2 weeks ago, we had Sonic 3 released. Both are having huge ratings. Both had a huge impact. And both of those should drive enormous merchandise sales. So if you look at JAKK Specific's earnings, they break it down in their presentation to their core toy business, which is growing. It's growing slowly, but it's growing. It's a decent business. And then they also have their promotional film merchandise. And in a year where that's really firing on all cylinders, they have enormous earnings. So this is one where, and also it sold off a little bit on Trump tariff fears. But I think this is another one where it's not like the United States wants to make cheap plastic toys in the United States, right? They're fighting over the high value add, high technology stuff. So I don't know how badly this would affect their business, but that's kind of the fears. But yeah, Disney's Wish did not really drive a lot of merchandise sales, but I think Moana 2 and Sonic 3, if that's the bet for a short-term swing trade, is that Moana 2 is going to crush it and Sonic 3 is going to crush it. I think that's a very safe bet. If you want to own this stock for a while longer, I think that what was causing the underperformance in the past was the CEO, who still is the CEO, but I really think he's been given a window seat and put out to pasture. And the executive vice president is running the day-to-day, and he's doing a good job. And this is now as a company that's performing at a high level. They have the ability to return capital to shareholders. And also in the past, under the original founder, they did a lot of acquisitions and growth by acquisitions. And the CFO has this background as the head of mergers and acquisitions. I think it was for Mattel, but I might be misremembering that. So I think this is, it went from a complete struggle, bankruptcy's door, to it's about to be an aggressive growth stock. And in the short term, it's all about these recent movie releases. But in the longer term, I think they're going to keep on performing at a high level.
Yeah, so I'm just looking at the chart here. So I imagine a lot of this is from dilution from the previous highs. I mean, it was at $300 something, but I think that's from dilution. So currently it's at $26. Obviously significantly off the highs, even with factoring in it being diluted. And so, I mean, you know, as you mentioned, like the new CEO has turned the company around, and so, I mean, how many X you think this could go? I mean, right now it's at $26. Where do you think this could go over the next however many years?
Yeah, so its price to sales ratio, it's only about 0.4. Now, I think most decent companies can get back to a price to sales ratio of 1. But also their revenue is down because Disney's Wish really bombed. So when there's decent movies, they're going to have higher revenue, and then price to sales ratio. So if I look back at historical price to sales ratios for JAKKs, I think they can be at a price to sales of 1. Yeah, if you look back to, so I think before the death of the original founder of the company, when it went through this period of mismanagement by the, his buddy and co-founder, it was at a price to sales ratio of 0.8. So without any revenue growth, that's a double. But then if you on top of that, you want to hold this longer term, they make money, they return some of that money to shareholders, they do some share buybacks. I think it's maybe a short-term double, longer term, much more than that. But yeah, it's an interesting one. And it's also fun to do a toy maker for Christmas.
Yeah, for sure, for sure. Yes, it's definitely a unique type of company. Like these companies are out there, but you know, no one's going out. Like Steve, you going out and freaking finding all these all these companies I wouldn't even thought of. But
Yeah.
that's pretty cool. How did you get introduced to like this company? Did you like buy a toy and like see it on the back of it, like buy a toy for your kid and you see produced by JAKKS or something like? How did you even find this company?
So I mean, I have seen their name brand on some toys here and there. Um, and I'm not a huge customer of theirs because I mostly like I'm kind of a huge Lego enthusiast, even though the prices are outrageous. But yeah, I don't own a lot of their merchandise. I don't remember how I found this one. So sometimes I run price to book screens and price to sales screens. Sometimes I see what people are talking about on social media. Sometimes if I find a company that I think is really amazing, I'll go to look at, there's a website called Whale Wisdom where every professional fund has to submit these 13F forms and you can see what else they own. Sometimes I'll find a company that I'm really excited about and I'll say, okay, who else also found this and has a big position in it? And what else have they found? Because I don't know if you're old enough, but that's how Napster used to work. So before streaming music, I would go on Napster and I would look for a song that I like and download it. But you could also see that person. You could also see what else is in their library. And it's like, well, if this person has the same favorite song that I do, what else are they listening to? And that's how I would find out about new bands in like 1994 and 1995. So if I find something really interesting, I'll see what other, hedge funds and investment vehicles own it in a large size and say, well, what else have they found? What else is going on? Um, yeah, I can't remember how I found JAKKS in the first place, but I think a big thing is as a value investor, when a stock is cheap, it has problems. So I got to find out what the problems are and are the problems solved. And my best guess is that this company executed very well under the founder. It executed terribly and he's still the current CEO. I just don't think they let him touch anything anymore. I think he's out playing golf all day. So it's been doing very, very well since they hired this new executive vice president CFO. And I think it's just pure management. Just there's this real scarcity of competent people out there, people that can really do their job well. I think that's really the limiting factor in most of life is just that there's a lot of people that half-ass their jobs and there's just not that many people that really execute at a high level every day.
Okay, so yeah, that makes total sense. So, and sometimes like some of these like people that run companies, obviously, it's kind of similar to. I have read the book, "The Psychology of Staying Rich" by Ted Oakley, and he talks about like people that have blown like fortunes. The parents would be go out innovative, very creative. They go out and make a lot of money for the family. Then it passes on to the kid, and then the kid blows the fortune. And so it's kind of similar with some of these companies like that. And, you got other factors like staying up with the times, and being able to adapt and to how business and the world is changing as well. And so it's good. I don't know if the new CFO or the executive vice president is younger, and I mean obviously he has a lot of experience with his prior where he's worked prior as well. Um, on a side note, I saw I was recently looking at Warren Buffett's filings. I saw he bought more Occidental.
Yeah.
And I was, I had to ask you about this. I was just like, he's buying more oil, and I mean, Occidental did fall in price. And what are you seeing there? Are you staying in tune with that? I know you're into like some of the commodities like oil and gas, and so I was wondering if there's anything new that's popped on your radar.
Yeah, it's a cyclical commodity. It goes through these time periods where the price is low, and it goes through these time periods where the price is high. In fact, one of the best charts of oil prices, it has this shape. It's called a bimodal distribution. It looks like this two-humped camel. And so this chart of oil prices has these two humps. One hump is supply destruction, where prices are low and people stop drilling. That's where we've been in this world where the number of drill rigs out in the different shale basins in the US, it drops every month. So we're in supply destruction territory. But about maybe a third of the time, the oil price is in demand destruction territory where supply didn't come online that fast enough. And now the oil price is how high it needs to be before people say, you know what, I'm not going to do that road trip. You know what, I'm not going to order this thing delivered. And that price where the oil price is in demand destruction territory, that could be like $120 a barrel. It could be higher than that because we haven't been there for a good little while. So it's cyclical. I mean, I think it would be a really bold prediction to say we're never going to be in demand destruction ever again. I mean, I wouldn't make that prediction. Are we going to, is oil going to be 120 in 2025 or 2026? I don't know, but so we had this economic growth for the last couple of years under Biden, but again, all the job openings, it's government employees and healthcare administrators. They don't use any natural resources. If we're going to be, growing the real economy, with Trump saying any investment over $1 billion, I'm going to sign all permits immediately, things like that. And plus, you have accelerated depreciation. So anybody that deploys real physical capital can have extremely accelerated depreciation in the first year. I mean, we could see this enormous movement of real physical stuff that we haven't seen for a while. And on top of that, China is stimulating at the same time. Now, Europe is still struggling. I've heard very, very few people predict that Europe's recession is going to be over in 2025. They're going to be back to the races. It's possible. But if India is growing at 7%, if China is stimulating, and if the United States is approving all permits and giving accelerated depreciation, might have, real GDP growth of 3 or 4%, that could drive oil into demand destruction. You could see $110, $120 oil.
Mm-hmm. Yeah. Okay, that's good to know. Good to know. Well, Steve, appreciate you coming on again. Where can people find you? And I'll be sure to link to them in the description below. But I know you're on X as well.
Yep. I've got my X account. My primary thing right now is Substack. I've started a little YouTube channel, slowly getting some traction. But I'm just Peter Lynch had this saying that you turn over 10 stones, under one of them you find this undervalued company, and whoever turns over the most stones wins. I try and write every weekday, five times a week, and so I'm out there turning over stones every day. And sometimes you just find this amazing stuff. It's a lot of fun. I'm really enjoying it, and I hope the readers get a lot of value out of it. The feedback that I've gotten is that I produce too much content. People don't have enough time to read it all. I mean, they're short articles, but it's 5 a week. So, but yeah, Substack's probably my main place. Unemployed Value Degen.
Yeah, for sure. All right, you all be sure to go check that out. Link to that in the description below. Thank you for coming back on, Steve. We got plenty of you writing 5 times a week. Then we may need to bring you on weekly or something. We'll figure it out. But I'm like Steve is getting to work.
No, thank you, Daryl. I really appreciate it.
All right. Yep. You too. All right. Take care.